Good afternoon. I'm going to get us started. Welcome and thanks to all of you for registering and, more importantly, showing up for this Ontario Systems webinar produced by InsideARM.com, extending your healthcare services reach through an EBO strategy. Ontario Systems is joined today by experts from USCB America and Experian Health. So let's get through some of these introductions. There at the top is Kevin Vernon Harris. He's a consulting director with Experian Health with over 15 years of healthcare experience. In Kevin's current role, he is responsible for consulting with hospitals and physician practices that utilize Experian Health's data and analytics to improve and enhance self-pay collections and processes. Followed up by Astrid Blackman. She is a senior vice president operations at USCB America, USCB, there we go, and is responsible for all revenue cycle operations and client relations, business development, contract compliance issues, medical billing, self-pay customer service, bad debt collections, and third-party liability accounts. Steve Scabetta is below Astrid on the handy-dandy slide you're looking at, and he is Senior Director of Channel Sales at Ontario Systems. His 20-year career path has included stints as a Senior Programmer Analyst, Product Manager, Implementation Services Director, and Application Support Director. In that time, he's helped dozens of clients solve problems and enhance the bottom line with the goal of fueling community missions through his connections to some of the most prominent data service providers in IT. Jason Harrington leads Ontario Systems sales and marketing teams, focusing on growing the company's business in all markets served. International receivables management and entrepreneurial experience have shaped his outlook when leading Ontario Systems revenue generation efforts. Hi. Finally, I am Mike Bevel, an editor here at InsideARM and America's favorite webinar moderator. On a poll I just did on myself. A few pieces of housekeeping. Please note the questions box available to you. All of your mics have been muted. However, you can send your questions via this chat box at any time during the presentation. Some we'll get to during the presentation. Some we'll save for the Q&A at the end. Some we won't be able to get to at all, but we will do our best. 2, here's the answer to my favorite question that 6 of you will ask at some point in today's webinar. Yes, you will receive follow-up materials from Ontario Systems, this PowerPoint, for instance, and possibly the recording, within a week or so of the webinar, so hold tight, and they'll get that stuff to you. 3, please make sure you take a few minutes to complete the survey after this webinar ends. The information is incredibly valuable to us as webinar producers, and we value your thoughts and opinions very much. Also in the survey, there'll be a space for you to ask any additional questions that we maybe didn't get to cover in the webinar or get to in the Q&A. You can ask it there, and I'll make sure that someone gets back to you with an answer. The final bit of housekeeping, I have some legalese that I need to read through on the record. And it goes a little something like this. This information shared on the webinar is not intended to be legal advice, but simply informed opinion from my panel. It may not be used as legal advice. Legal advice must be tailored to the specific circumstance of each case. Every effort has been made to assume this information is up to date. It's not intended to be a full index of the law in any area, nor should it be used to replace the advice of your own legal counsel. And with all of that out of the way, I am going to turn this over to Steve and Jason. Gentlemen.
Great, thanks, Mike. Appreciate that. Appreciate everybody taking time out of their day and to join us. We've picked a couple topics in the last few months to kind of take to the market and talk about, and our last one was around student loans in this space, which is obviously a big trend. And today we wanted to talk about sort of the other big macro trend that we see in our markets that are really driving things, and that is just the whole rev cycle, how it's changing, and what data we believe is changing that, and then kind of what opportunities does that create for folks that are in the space to take advantage of it. So today's session is just intended to kind of touch on those topics and share some information we think is pertinent and relevant. And so to get us started, I'm going to let Steve take the first slide here.
Thanks everybody for joining us today. We're going to walk through a handful of slides here pretty quickly. Definitely not going to read to you by any means, but what we thought would be helpful to do is get the various viewpoints that might help us to kind of frame up the market problems. So, as this particular first of those sort of framing slides reminds us of is, and also, real quickly, while we talk about ACA, excuse me, in this meeting today, we're going to use ACA maybe not in the classic context we often use it in the ARM space, but here, the Affordable Care Act. So please don't allow us, or myself particularly, because I'm in the habit of saying ACA, don't allow me to confuse you. The context today is going to be more about reform. So while the Affordable Care Act continues to add insurance coverage to more and more patients, I'm seeing and maybe in your field as well, the cost of premiums and deductibles continues to really be a great burden for patients. And I think the simple truth is that medical bills are a greater concern for patients and families as they sort out the bills, as this graphic depicts. They're on the kitchen table, sitting at the kitchen table every night, trying to figure out how to navigate through this. And what we are learning is that 1 in 4 families are reporting significant financial burden due to medical expenses, and the need to manage these receivables strategically has never been greater. At least that's what we're seeing, all of us on this panel today, what we're seeing with the various parts of the market that we touch. Mike, if you don't mind, maybe we'll flip to the next slide. Another viewpoint here is from the Commonwealth Health Fund's, their research, and these statistics indicate that no matter, maybe I would say, no matter what research you like to tap or who you want to talk with, the facts are kind of in. Patients and consumers are having a problem paying their medical bills. And as we kind of highlight here, patients are changing their way of life due to medical debt and are entering into long-term payment arrangements to gain some form of relief. So the question we can ask ourselves today, all of us collectively, is how do we assist these healthcare finance leaders to find a means to manage their AR portfolios while keeping the patient's needs kind of at the center of the strategy, at the center of the story. And then how do we do this as well in a win-win manner so that the provider wins, as well as how do we also expand our businesses and our revenues and our services? Compelling thoughts. Mike, next slide, please. I can only assume that the folks joining us today understand that healthcare debt is not new to our markets. But I would also say that because of that history and some of the data like you see here before you from ACA International, that trend line is very validated. It's pretty trusted, and there actually is opportunity there for us to help and serve and going back to that win-win point I made a moment ago. I want to quickly highlight on this slide, we talked about 2 healthcare market segments, hospital and non-hospital. And non-hospital was categorized as what you might guess, physicians, clinics, labs, ambulance services, opticians, even dentists, I think, were rolled up into that. But if you look at those 2 buckets, the hospital and non-hospital research from ACA, you note really quickly that that combined market segment or pair of segments rank #1 in ARM's kind of evaluation of the market and where opportunity may lie. And I think, maybe Astrid, I could maybe, I recall you might have some observations you made yourself about research that you've done with your clients and such.
Sure, thank you. We have seen a slight reduction in our referrals on the bad debt side of things in relationship to the Affordable Care Act coming into play. That, of course, gives us a reduction in referrals, however, an opportunity in an extended EBO process. So for one particular client that I can speak to, we are starting to see a 30% referral drop.
Any other? Yeah, please chip in there. Thanks, Kevin.
Yeah, this is Kevin. So, and what we see too from our side with the clients that we work with out in the market is that a lot of clients do not have a good or at all a dedicated collections group. Because they don't have the expertise in-house, so they're leaving a lot of opportunity on the table for an EBO to come in and help collect some of those dollars versus letting it sit, strictly statement the patient and wait for it to go to bad debt. And I think there are also other facilities that have started to cut back on some of their collectors that are in-house just because of the financial constraints on the health system, and they feel that it would be, you know, better suited for an EBO to come in and kind of help clean up and do those collections versus trying to afford the expense of hiring more internal staff.
Excellent, thank you. Maybe the next slide, Mike, please. So if we kind of take a macro view here a little bit, and let's just look at the market trends that we're seeing and then some of maybe the real influences on it. As you can see on these bullets, I know in my personal experience, the advent of an HDHP into my household has changed the way we behave as consumers, and I think that's really, really true for so many folks across America today. In 2006, there was research that was done in employers, and they found that just about 4% of workers were covered by some form of an HDHP. It was the Kaiser Family Foundation did that research. And today, those findings are eclipsing more like 20% of households have some form of HDHP. And I think what's really noteworthy there is the high premiums that are often associated, but also just the nature of a deductible plan and that reset of that plan every January 1st. So it's really not unusual at all, as you can see on the fourth bullet here, for pretty significant, whether it's a household slash family or an individual, for those deductibles to be very noteworthy and actually maybe burdensome. I mean, they do promote consumerism, agreed, but they can be surprising and sometimes catch people a bit flat-footed. Folks, other panelists, do you have observations as well along this line?
Yeah, I think when we look across, Experian Health processes about 2 billion healthcare records, and when we look across all of our data and talk to our hospitals out in the market, we are definitely seeing what you just mentioned there is that high deductible health plans are playing a huge part in what's causing a lot of the bad debt expense. We also see, because of the Affordable Care Act, you have a lot of consumers that have elected to step out of their employer-offered health plan due to cost and choose a plan through the exchange. What comes with that is even higher deductibles. So the premium may be less than what they were paying through their employer, but their deductible, instead of say $4,000 a year, could be $15,000 a year, which at the end of the day means more responsibility that they are responsible for and more that the hospitals have to go and collect. And then for those people that don't have insurance, that are required to go through the ACA, depending on their age and other factors, we're seeing that they only have extremely high deductible plans offered to them to pick from. And so this is kind of, I think, a huge problem, and I don't see any end in sight.
And I think, I guess the underlying premise of these trends, these stats, these observations are that those provider business offices aren't equipped, most often, aren't equipped staff, maybe talent, even the associated technology to handle this increased volume and this increased chaos. So that's, I think underlying, and I hope everybody on the call has maybe seen this in their own business, that does create an opportunity to return back to that win-win point I made earlier. So maybe the next trend, Mike, push forward here a little bit. So the gears are in motion, right? I mean, no real surprise. The one that I'd like to drill down on here real quickly is the aging population. I found this data to be pretty interesting as well. The market driver for the aging population, we should just consider or observe that the Medicare rolls are definitely on the increase. And according to AARP, about 8,000 people are aging into Medicare daily. And what's noteworthy about that is that, and this is again as per AARP data, which I think is pretty trustworthy, of that 65 and older population, nearly a quarter of the boomers aging into Medicare have no retirement savings, and 14% have no personal savings whatsoever. And then if you look at the wave of folks right behind them, that next generation, the story isn't a whole lot better. So what we're finding, and maybe what we were maybe all expecting, is the burdens that the average retiree will face, which can be, $5,000 or so a month in some cases. Some estimate that through the lifetime of a retiree, it could be hundreds of thousands of dollars to kind of afford their medical life, to cover their medical life. This leads us to really the growing realization that these new Medicare enrollees, both today and in the near term tomorrow, aren't going to be able to behave as some of the Medicare enrollees may have in the past. Again, another market driver here that can have a lot of influence on opportunities that we all have in the marketplace. Team, I didn't know if you had any other observations personally there you want to chip in, or as a reminder, folks, please send Mike your questions. We'll be watching for them throughout the session as well.
I'll just comment on the market driver here. We are, in fact, seeing an increase in the managed care population being assigned through an extended business office solution. So absolutely, there's a lot of additional pressures coming into patients overall with a higher deductible. But when we look at the extended business office solution process, there may be opportunities to, although you're not receiving as many high dollar balances on the bad debt side of your referrals, there may be an opportunity to make up some of that revenue through the managed care plan and billing.
Yeah, I would agree. I think we're seeing the very same with our clients on the provider side as well. Maybe next slide, Mike, if you wouldn't mind. Thank you. So the call to action, right? This is a great set of research, a great body of thoughts, maybe some experiences that are relevant both for attendees and panelists. But, let's think about this. What does the buyer say? What does the CFO, the VP of Rev Cycle, what are their thoughts on the matter? And as we state here, the 2013 Black Book survey of nearly 2,000 such leaders have indicated there's going to be an intentional redirection of time, resources, and talent to address issues surrounding the rev cycle, particularly influence of ACA, influence of HDHPs, merger and acquisition influences as well. So as those providers kind of struggle to respond to all this changing landscape, I think it goes to reason, I think, that will create opportunity for those of us that are looking to provide them services and maybe extend their reach. Well, with that, Mike, we'll go to, yeah, thank you. So what we'd like to do is kind of start to maybe flesh out a little bit about the EBO strategy in general. We didn't want to assume too much, and we thought one way to frame that up was just to think about the EBO strategy today. So, the general framework of an EBO strategy is really to serve, I think the E of extended is really a key word. It's the extension of the provider's business office, and by extending that business office, you have to take into your view, your responsibility even, the patient and the community that they serve. And I think it's a natural part and maybe a really great beneficial part of the EBO strategy. Providers are seeking partners like ourselves, EBO partners, that can deliver proven, successful programs while also recognizing the need to engage the patient because patient satisfaction is so important in the market today, tying all the way back to reimbursement, et cetera, and consumerism, I think, as well as an influence. All those things, I think, help us frame out what an EBO should look like and what the strategy should be comprised of. Any thoughts from the team?
No, I would agree with that. And I would just, Steve, kind of go back and point out a comment that you had made, and I think that you're correct that we definitely seeing a shift in the hospitals going to EBOs, and there's more focus, especially from CFOs and Vice President of Revenue Cycles, to really focus on self-pay. So if everyone thinks back, 10 years ago, most hospitals were pretty good financially, mainly because they were relying on their payments from their commercial payers and from their government payers. And as we've seen more and more cutbacks in reimbursement to facilities from the government payers, and now with the introduction of the Affordable Care Act, really the hospitals have no choice but to put more effort and dedicated effort on self-pay collections on the back end. So I think that's why we're definitely seeing more hospitals kind of really starting to look at getting EBOs involved so that they can really focus on collecting that cash that's desperately needed.
So to that point, Kevin, just curious, because I've heard some of your guys' analysis in the past few months. What's the shifting nature of the percentage that self-pay matters to a hospital? Do you guys have any data around how much of that is, how much of an impact is self-pay today versus what it was just a few years ago to the hospitals?
I don't have that. Yeah, I don't have that in front of me, but I would say, definitely a good 30 to 40%.
Which the number I used to always hear was like 3 to 5%. And so the reason I was asking the question is I mean, these are just the driving factors that create the opportunity, I think, for helping our hospital customers out, because they're not positioned to take this up. Most of them, that is, are not positioned to take this on themselves. They need the expertise of the technology, the analytics, the service providers to kind of come in and help solve the problem. So I think that opportunity, manifests itself in lots of different ways. And so if you have a customer that you're doing a bad debt project with, as Ingrid or as Astrid shared, there's some telltale signs that if you're starting to see some of these things like referrals dropping, so on and so forth, you could be getting impacted by some of these macro trends, thus creating an opportunity to kind of create maybe an EBO solution, a whole new revenue stream if you're not doing that today for that customer. So as we kind of go through the next few slides, hopefully you'll be able to see some of the red flags or opportunistic flags that might kind of be there that might change your strategy with those customers and create new money for you. That's really the hope and the goal here.
Okay, this is Steve real quick. I think one thing I'd like to highlight on this slide as well is now that we're getting down into maybe some of the brass tacks of what that EBO, maybe the EBO's marketing sheet might look like. What sort of services can I attain from you, Mr. EBO? I wanted you to note that we talked a lot about the patient and the consumer, which is our classic early out programs, but we're also seeing a greater influence of the outsourcing of insurances work, denials work, appeals processes, under and overpayment processes, and even because of so many consolidations and so many, the advent of a lot of change out, forklift upgrades of patient accounting platforms, that you're seeing work down projects as well, because the provider wants to focus on the new and roll forward and be able to maybe provide the old AR to someone who can take that time and focus with it while they are looking at the new and the new enterprise. So we wanted to highlight here that the blend is also, or maybe the mix is also getting richer as well. It's so much more than your classic early out program.
I'll comment on that. Precisely, I think that we have found ourselves in a very unique predicament where we're expected as a provider of services and a partner to our clients to continue to expand some of the services. And normally we have to be ready and listening to our clients' needs for an expansion of our EBO and the opportunities that are out there. I find myself constantly with our clients listening to their pressure points so that we could be in a better partnership to complete their needs. We find ourselves that we have in the past few years actually extended some of our services really through an extended partnership. We may have started doing bad debt collections, may have started to do early outs, and as we partner and our client believes in some of the services that we render, our expansion of services has continued to evolve. So for USCB, as a vendor of revenue cycle solutions, we offer just an array of services that allow us to partner with our clients. And at this point, we probably provide a front-end to a back-end solution. Again, partnering with our clients to making sure that we're listening and attentive to their needs before we actually gain experience, knowledge, and implementation of some of these processes.
Yeah, and I would just also add, we're definitely seeing, I'm sure everybody is hearing, a lot of health systems are migrating over to new HS systems. We definitely see a lot of migration as part of that. And so when they're migrating to a new HS system, a lot of times they're not rolling over that old inventory. And so because of that, they're trying to figure out how do I, with the staff that I currently have in place, handle existing and new inventory in my current HS system, but how do I run down and keep an eye on, keep the pulse on the old inventory in our legacy system. And so they really look for, as Astrid mentioned, someone that they trust, ideally that they're already doing business with, that can kind of come in and help do some of that working credits down, following up on third-party outstanding liability, et cetera.
And Kevin, just to piggyback off of that, we see a lot of that as well in our customer base, and that's a great opportunity for someone who is not as already into this part of the space to kind of get a chance to get their feet wet, so to speak, and to kind of prove themselves, right? To kind of get a project that's a little bit safer for the provider. It's a little bit, it's just a different set of circumstances, but it's a great exercise in sort of learning the basics if you're not already doing those kinds of services. So, looking for those kinds, that's another, I would say, sort of, early opportunity flag. If you see a health system that's a customer of yours on the bad debt side, and you know that that's coming, that might be an opportunity to position yourself to do some of those services. If it's just for a short period of time, if priced correctly, obviously you can do really well doing that. There's been some comments and questions kind of come across, and there's one that I think falls into the same category, and the comment was that hospitals are working high balance accounts, inpatient high balance accounts that comprise 20% of their inventory, and farming out 80% of low dollar outpatient accounts. And I'm not sure if you shared that with the group here, but I'd like to hear from Kevin and Astrid both, just to see if they've seen that as well. My initial reaction would be from our dealings that is probably more market. That I would not describe that as a general trend. I would describe that more as like situational. But are you guys seeing that in the analytics side or in the servicer side, that they're holding on to the 20% high balance and letting go of the 80% low dollars?
What we've seen varies, to your point, market, client to client. I would say more often than not, we're finding that, especially the larger health systems, the inventory is so high, especially if they have hospital and clinics, that really the mindset today is let's focus on high dollars, right? Even though those high dollars may not, at the end they pay, and your smaller dollars may, there's this feeling that, hey, look, we only have a limited number of staff and we've got X number of accounts, so let's really focus on these high dollars and get those worked. And if the low dollars move through the process on the bad debt, so be it. So that's kind of the trend that we see for most facilities.
Yeah, I think I'd add real quick to that. It may not just be dollars as the criteria. It might be a little more multidimensional, looking at risk, looking at analytics, scoring, things like that help a provider decide what they'll keep and versus what they may ask for help with.
Astrid, what about you? Are you guys seeing that kind of approach by your customers? Or
I'm sorry. Yes, absolutely. We are definitely partnering with our clients to take on some of their pressure points, and some of their pressure points relate right down to dollar value of the account. What are they expecting to receive, and is it worth their while to continue to pursue? Dealing with the challenges internally, whether they are, staffing resources that they don't have available, or issues related to budget, or issues related to political matters, and inability to hire untrained staff, all those items have resulted in us being in a position to assist with the lower balances. And absolutely, I am seeing that the providers are keeping the higher dollar balances. At the end of the day, I think the strategies that you put in place to work the inventory and the dollar thresholds really matter. We are able to relieve some of our clients' stress levels by being able to touch their lower balances, generating revenue for them at a reasonable cost that they don't have to absorb.
Super.
Yeah, I think that.
Oh, go ahead, Kevin.
No, and I would agree. You know, I think we'll be talking about this a little bit later, but I think the key is, you know, is the EBOs have an opportunity to really kind of help change that mindset of being able to not just focus on balance, not just focus on age of an account, but really through strong data and analytics, be able to identify those patients that have the ability and will pay. And so that could range from a small balance to a large balance. So being able to look across your entire inventory and determine what are those accounts most likely to pay and which of those that are not, and where do we focus our efforts.
Yeah. And I think that kind of takes us back to the slide, which is what does a successful EBO look like? And we can kind of go down the laundry list here, but it's, you know, we sort of touched on a lot of these things, right? At some level, it's opportunistic and it's situational. That's the advantage you have with your unique relationship with your customer. And I think the trick here is trying to identify some of these opportunities and then position yourself to be successful in taking those on. Obviously, when you're a servicer and you want to take that chance, you want to make sure that you have all those pieces in place. So, you know, the technology, the analytics, the know-how to put all those things together to be successful. But Steve, I'll let you kind of take us through this slide to kind of talk about what that successful EBO kind of the attributes of it, and then I'd like to come back to some of these questions. There's a few other questions I want to touch on once the slide's over.
Sure, yeah, I can do that. That's just I won't read to you guys by any means, but if you look at the early out and AR acceleration projects, it's just really the aggressive pursuit of those active self-pay balances, offering discount programs, settlement programs, setting up payment arrangements, going way back to that earlier slide about providing relief and providing options to the families. The work down projects, you've heard both Kevin and I kind of elaborate a little bit about those. Another real clear benefit of those work down projects is the ROI can be very compelling because the providers probably got a pretty hefty cost line against that legacy platform and the number of licenses that might be still active on that product line. So if they're able to reduce that monthly obligation for that project or for that platform that's being worked down, that fits right into your pricing model and how you can provide them benefit. Under and overpayment, as well as small balance cleanup projects, you probably have considered or maybe are doing those today. But the under and overpayment projects, as well as down below the claim status and denials, it's all the focus of the truth is ACA, again, Affordable Care Act, has provided insurance coverage to more people. So insurance claim volume is also increasing. So that's just going to... Sorry, we're picking up some static. I'm not sure if everyone's hearing that. But you know, those underpayment, overpayment programs, as well as the claim statusing and denials, and I think the key word down on claim statusing and denials is surrounding automation. The use of EDI X12, the use of payer websites, the automated navigation of those websites are really, really rich ways to return value to the provider that maybe they're not able to do with their own current time or technology or talent. I think that would be a pretty quick summary of those, Jason, if you wanted to bounce back to some of the submitted questions, maybe that's a good one.
Yeah, and one of the things that one of the participants pointed out that they're expected to screen for charity care and Medicaid, which is not on this particular slide, but it's certainly some of those special cases that that are very much business processes and problems that that are going to be, you know, an EBO would have to solve. One of the questions that I did see that was raised up was, are you expected to see more loans funded by EBO vendors being offered to patients to offset increased balances driven by shifts in deductibles? And again, I can't actually see who asked that question. Mike's kind of funneling this to us. But I think that that's a trend that we are starting to see more of. We're starting to see new funding sources, and I think it's the combination of the changes in the, the credit card reform from a few years back affects this. It's a new financing vehicle, new product for finance companies and banks to try to kind of get into that space. And you see this, the one that comes to mind for me is Credit Care, which I believe is a product of one of the big finance companies out there. And it's, very specific, very targeted to this kind of debt and sort of pre-qualified only for this purpose. Kevin, Astrid, Steve, are you guys seeing other things like that where people are using this as an opportunity to create new products to help consumers deal with this problem?
They might be miming their answers.
I'm sorry. This is Astrid. I don't have enough feedback to provide on this specific question at this time.
Yeah, and this is Kevin. I would say, we from the hospitals and physician groups that we work with, I have not heard of, these type of any new programs out there. The one that I hear a lot about, to your point, is Care Credit. I know that's used quite a bit out there. They have different variations of how that works as far as, the patient working directly with the creditor versus the creditor working directly with the hospital in some type of payment arrangement. So, but I haven't seen a lot of that out there. I think part of me sees and feels that the hospital is probably a little shy of going down those routes, especially due to some of those programs take the patient experience kind of away from the hospital, so they kind of lose control of how the patient interacted with and treated. So they kind of shy away from a little bit of that.
Okay. Steve, I don't know if you have a thought on that. Maybe we can move to the next slide and kind of keep going through the deck as we kind of take some questions as we go.
Sure. Yeah, let's do that. Thank you, Jason. So what we thought we could do here is just kind of checklist down through the various measures that the provider problems that might exist out there. And again, not seeking to read these to you, but what we really wanted to maybe highlight a bit here is some of the softer truths. You might find in the opportunities that that you're able to provide back to your clients, that they're missing their customer service and quality metrics. And because of that, you may, as EBO, have the ability, the time, the bandwidth to improve those metrics. I think another truth down at the lower part of the screen is that the provider staff is simply overwhelmed. The staff is turning over. The staff is worried about the impact of ACA, and all that yields a more inexperienced staff that's seeking help. Kevin or Astrid, do you have any comments on some of these measures?
Yes, well, some of the things that we are seeing our clients are challenged with is tightening budgets at the provider level, reduction in recovery rates, increase of managed care, which definitely will dilute some of their recovery rates as well, increase in the charity request. So we are definitely seeing many problems. I mean, this is a great list of problems. And again, the problems that we're there to solve are in relationship to whether it's the front, middle, or back-end process by taking on additional workload from our clients, listening to their challenges so that we are ready to really serve them with a more holistic approach, a superstore type of approach, a one-stop shop, so to speak. I also wanted to comment, I thought I saw a question come through about new players. Is there enough business for new players in the market? And I have to comment that just my own personal opinion, when you partner with a provider of service, you actually have the ability to continue to expand your services because of the need that's out there. In addition to that, when you provide service level expertise, that removes some of the responsibility to look at, for instance, the lower balance accounts. You build a trust in that, and they tend to expand some of the services that you would normally otherwise not be ready to partner and accept. So I think there is definitely a lot of work from the provider's standpoint and accessible for vendors such as ourselves, that we are able to provide services as the needs arise.
And to kind of piggyback on that, Astrid, I think part of that question too is is there enough volume out there? And I think it's pretty important to point out that we're just at the beginnings of this sort of macro market trend, which is these policies, these high deductibles, all these things are they're sort of just now really getting into motion for the masses. So I don't know anybody really knows what the consequence of that is or what the opportunity of that is and consequence of those sort of structural changes in the system for service providers in particular to get into the marketplace. Everything that we study, everything that we research tells us that it is going to make the market bigger, not smaller. So I think the volumes are there to justify new entries into the space. And I think we'll start to see new inventive things that go along with that, as opposed to just sort of the traditional collection commission-based sort of structures or hourly cost-based structures. I think we'll start to see people invent new ways to deliver the service and monetize it as they kind of come into the space. But we're certainly seeing a lot of new players coming in the form of joint ventures, or coming in the form of getting together with an alliance of hospitals and creating a new opportunity that way. We're seeing it on the system side, and I got to think that that's making its way, Kevin, to your side for increased analytics and demand for products, as well as increased RFPs for Astrid folks like yourselves. So I do think that we're at the beginning of that volume picking up. We're not anywhere near the market maturity point, I don't believe, at this point in time. I don't know if anybody has a thought about that or not.
I think I'd run a point alongside that and offer the question asked also, is it difficult for a new player to break into the market? And I would suggest that, as you said, Jason, that the volume today and in the future is there to warrant new players. But the new players, healthcare finance, healthcare debt, particularly insurances, denials, those sorts of programs, there's intellectual property that has to be there in those solutions. It's not solely a consumer-focused classic collection program. And so sometimes skills that a current ARM organization might have don't all directly translate and provide solutions. So there is some growth, to your point, Jason. Maybe there's some acquisition that the ARM entity does on their own to bring talent on board their team to drive out some of these programs that focus more on claims and claims management.
So in light of time, we've got several more slides that I kind of think we should pick up the pace and go through quickly, because there's some other great questions I think are maybe better time spent. So Mike, if you could toggle through the next slide, and maybe just kind of gloss over the next few, Steve, and then kind of get to some of these other questions, because there's a
sure. Why don't we
conversation?
Yeah, let's just do that. Let's just kind of leave this up as background, and then why don't we hit a question or two? Then we'll do the same thing with the next slide. Leave it up as background, and then keep hitting things off the chat box.
That's fine. So the question here, which is more of a comment, and I think this slide is actually the one that is pertinent to have up here for this comment, which is it cheaper for them to hire more staff since most EBOs will charge a fee for collections? No collections, I'm not really completely sure what this, no collection fees, and I think
No
the point of the comment was, I'm sorry, Mike?
I think no collection, no fees is the end of his comment.
Yeah, and so I think the question in that comment is, doesn't it make more sense for these guys to insource this work? And, Kevin, Astrid, I don't know if you can share any stories or any thoughts around what you guys are seeing. When we talk to hospitals on the system side, most of them are trying to avoid taking on more costs because of the profitability issues that they're facing. So are you seeing a similar thing from your point of view?
Yeah, absolutely, and that's where we work with a lot of our clients, as in partners. Is that can you throw more people at the problem? Absolutely, but you've got to figure out what the problem is, right? So by using data and analytics, for example, our Experian Health data analytics and our 2 billion healthcare payment records that we have, you want to be able to identify those patients that are going to pay. So you're going to be working smarter. So a lot of hospitals are finding EBO partners that are partnering with Experian Health and that have really great data analytics to be able to collect as much as they can. Or the hospitals are looking directly to say, you know what, I'm not going to hire more staff. I'm going to keep the staff that I have, but we're going to focus on the accounts that are going to pay. And we're not going to spend our money and resources on the accounts that through data analytics we've identified are never going to pay us, or those that maybe qualify for presumptive charity. So it's really using good data analytics and working smarter, whether you do it yourself or you use an EBO partner that does that. And I think that's what EBOs should really think about to distinguish themselves in the industry, because a lot of people are getting into this EBO space, but when you go before a client, what makes you different than everyone else, right? And so to be able to come in and say, hey, we've got really strong data analytics, we can really improve your bottom line, you're not going to have to hire more people, I think that really says something.
I have to agree with Kevin. We definitely know that you can't possibly do things just blindly. You have to use technology to help you guide you through some of the inventory that's assigned. The question really was, is it cheaper to hire? I think that also relates to a good rate that you might get from a vendor that would be definitely to the advantage of the provider or client. There has to be a win-win, of course. It's not like you can provide services for free, but at the end of the day, I think you have to be conscious that the market is there, the needs are there, and you have to align yourself properly to be able to make a small profit. And how do you do that is by using technology many times. Being able to scrub and make sure that you have right party contacts, scoring the account so that you have the ability to determine propensity to pay, call mining to make sure that we are approaching or addressing with the proper scripting those things that you tend to say in order to generate a payment versus just a conversation over the phone. Evaluation of charity potential, that also is very helpful, so you're not wasting your resources on maybe an inventory of accounts that will not generate any revenue. So absolutely, I agree. I couldn't agree more that there needs to be a lot of analytics in play so that, one, you can stay competitive by providing a competitive rate and still generating the collections that our clients desire.
Yeah, I think at the end of the day, it comes down to, we're all business folks, and at some level, we're all salespeople, whether we proclaim to be salespeople or not, as part of our profession. But at the end of the day, it's that value and articulating it. And Astrid, I think you just did a nice job of sort of summarizing the fact that when you consider all of the costs and you consider sort of the net return, it's hard for most, my experience tells me, it's hard for most providers to be able, they're just not focused on it. They're focused on the care, they're focused on all the other core things that they do, which is all very important. But most of the time, folks can come in and provide an amount of focus and expertise and talent and technology that makes them produce a better result. And at the end of the day, that's really the outcome here, and to do that profitably, which I think you mentioned, which is very important. Yeah, I think it ends up being a pretty powerful sell. But sometimes you have to articulate the whole value proposition. You can't just stop at the very surface level. You kind of got to dig in and really articulate all of those costs to kind of quantify that.
Right.
Mike, can you go to the next slide, please? I don't know, Steve, is there anything you want to hit on this before we get to the next question?
No, I don't think again, let's just leave it up as a backdrop for sake of time, but there were a few questions that came up, and Astrid touched on it a bit about charitable programs, particularly the influence of 501R. And what I see in my interpretation of the 501R regulations and, its advent to the notification periods, the application periods, clearly a burden of the financial assistance program, the FAP, falls on the provider. It goes all the way back to their collateral. It goes to the experience of the patient as they walk through the lobby, the informing of the financial assistance program. And so a good portion of that burden may still rely on the provider. But what we're seeing, and what you may have likewise read and interpreted in the collection practices aspect of 501R, is there are the notification and application periods, 2 120-day periods, that have to be clearly managed, they have to be documented, they have to be applied consistently and fairly, and the patient has privileges and rights within those 2 120-day periods. So I feel like, all of us on the phone today, because we're all tuned more towards process and technology and automation, we have a much better opportunity to ensure those programs are executed than maybe some of our clients, our provider clients might. Now, there are some things that are buried in that regulation around, I think the acronym is ECAs, Extraordinary Collection Activities, had to do with credit reporting and some other things like that, if I recall correctly. It's been a little while since I read it. But I don't believe that typically we would all get to those sort of practices too quickly in an active or an early out program. So will it create opportunity? I believe for some providers they'll embrace it very clearly, and other providers will think just because they put a poster in the lobby or at registration that they think they're complying. And at the end of the day, when the regulation does finally indeed drop, we'll see that they're not complying.
Should I head to the next slide?
Yeah, go ahead, Mike.
Well, if you'd allow me, I'll just kind of summarize a little bit here. And Jason, maybe start to, or continue to kind of cull through the questions that are being proposed, because that's the really good stuff. We're excited about all the questions and comments. So on this slide in particular, we want to return our focus a little bit, to the patient, to the engagement of the patient, to the changing demographic, to preferences and behaviors that we all express. And I know that, Kevin, a lot of your technology really helps to provide a better understanding of behaviors and habits and maybe even preferences that a patient may have. So because we see that giving patients options may be a really strong breakthrough in the promotion of collection programs. Does the patient prefer to hit an IVR off hours? Do they prefer to come to an online portal and check a balance to make a payment? All those sort of very, very understandable technologies, but the things that we can offer to the provider that they may or may not be executing well on their own, that extends the business office 24/7, right? That opens the doors 24 hours a day.
Absolutely, in providing things like presumptive charity to be able to those patients that truly cannot pay, to be able to handle those accounts versus wasting time and resources chasing after the patient and creating an uncomfortable circumstance. And also, as you think about your collection strategies, how often do I call this person with a dialer? When do I call? How often do I send a statement? At what time during the 90-day, 120-day period, whatever that facility has, do I call? And that's where you really need some really good data analytics, because if the patient is going to pay you, you don't want to make a phone call 15 days after the statement. You want to give them some opportunities to pay. Whereas those patients that may not be your best payers, you want to be able to hit them right out of the gate because they'll take a little bit more work effort.
That's correct. We definitely have seen a demand for extended business hours and normally weekend hours in order to partner up and meet the patient population and their preferences. So, in fact, we are seeing patients call after work between 5 and 6, 7, 8 o'clock at night. So we're definitely seeing a shift where people are more expecting almost that you're there to resolve some of the outstanding balances, of payment plan arrangements, settlement offers, whatever it is, or merely an inquiry or a dispute. So we definitely are seeing a shift in the demands for extended business hours in terms of truly engaging with the patient. The data analytics help tremendously because we also don't want to overextend the calling volume of just to reach the patient. So the data analytics allow you to determine after how many contacts will the patient return your call. So we have found that to be very useful in our environment to be able to better partner with our patients and really gauge the results as a result of the data being analyzed, whether it's 5 calls, 3 calls, 2 calls, what really affects the inbound call activity from the patient and the extended business hour approach.
Yeah, and also just an even simple thing that we didn't mention is, setting up payment plans. I'm sure everybody on this call, sets up payment plans, whether it be if you're currently in the EBO side or on the bad debt side. And one of the challenges that hospitals and our clients face as well is, what is that amount? What can a patient truly afford per month? Because you don't want to say, sure, offer $10 right out of the gate when maybe they can afford $200 a month, and you don't want to start off with how about $500 a month when maybe they only can afford $100. So again, it goes back to that good data analytics to be able to determine right out of the gate, what is that starting point that I should ask the patient for? What is their financial situation, and what should I ask them for so I don't undermine myself or go kind of above and offend the patient?
Absolutely. So along those same lines, one of the questions from the group, Mike, go ahead and I think you can go ahead and toggle through the next slide. We're really running up against the hour here, but Ashley, I think this question really is best sort of delivered over to you, which is, I'm going to change the question a little bit, which is, how are you partnering with your customers with, they're specifically asking about nonprofits, but I think it applies for both nonprofits and profits. Training, how are you partnering with your customers to make sure that your reps are getting the right training for this different kind of call and experience and consumer interaction? And along with that, how does that affect your compensation models, if at all?
First and foremost, I think what's important is understanding our clients' charity plans, or what I don't know the right terminology to indicate at this time, but really is understanding what their financial plans offer. And so to us, it becomes very important that the more prepared the staff is to address those demands or expectations, that we partner with our clients for training. Now, we do have sporadic training, such as maybe every 6 months or a year. We also take our staff and we introduce them, and we have an in-service with, we have a one-stop shop. And what I mean by that is a client service model that we focus on the specific client in each one of our areas. That's our claim to fame, so to speak, at USCB, where we service the client from A to Z by one dedicated team. So that dedicated team is aware of the trainings, and we partner with our clients on a 6-month or an annual basis as new regulations come out, as new policies and procedures come out. So we're constantly in the know because we're handling one client at a time. Hopefully that addresses the specific question you had for me.
Yeah, and I would just
the training one. Are you so I think the question about the compensation models, I think the real question the audience is asking is, do you guys do a salary plus incentive, or is everybody salaried and there's no incentive? Just how are your reps sort of generally
rewarded?
Yeah.
Got it. Rewarded. Well, there's a couple of different models. It depends on what specific type of process you're speaking of. But let's say on the early out, our objective here is to make as many outbound calls as possible to be able to reach the patient so that we could ultimately turn that into a collection or a dollar. So we make the process and incentivize the staff with the number of outbound call activity or the immediate resolution of call at the point of contact. So we definitely create various measurements so that we can actually reward and recognize the proper behavior, so to speak, on the staffing level.
Super, thank you, Kevin.
And I would just comment too. I'll for a disclaimer. I don't run an EBO, but I will say from my experience, I used to run a revenue cycle for a large health system in Minnesota. And I think what Astra keyed on is a keyword partner that one should take away from. What a lot of hospitals really look at is truly partner, not a vendor, but a partner. And that is someone that can come in and seamlessly be transparent to the patient. And so when I brought in an early out vendor to my organization, training was key because I wanted to make sure that the patient experience that our patients expected continued with the early out agency as well. And so we actually would bring some of the early out staff into our organization and give them training in our systems, give them training on our policies and procedures, and kind of how we handle patients and issues from day to day. I think at the same time, being a partner, if you disagree or you have a better way of handling a process or improving a process, I think being a partner, you should definitely bring those recommendations up to the client and say, I understand that you want us to handle this situation or these situations this way. However, we have, based on our technology or our own processes, we have a better way of doing it that we think will benefit you at the end of the day. What are your thoughts about that? And I think that the clients would definitely appreciate that.
That's great advice, Kevin. I think we're right here at the end of the hour, and I know we need to wrap up. There were several questions we actually didn't get to that we will follow up, and for those questions that we can't answer, we'll share some written answers in that follow-up. Steve, do you have any parting thoughts?
Yeah, I think I would just offer, Mike, if you want to flip to that closing slide there. I would offer that the EBO strategy is really exciting. I have been in healthcare receivables for about a dozen and a half years now, and one of the reasons that really caught my attention early on was some of the, not to get too soft on you guys, but some of the benevolence of it. And I really feel like the EBO strategy and where the market need has kind of taken all of us, and that patient-centeredness of the strategy really provides that win-win. And that really gets exciting because when all parties are winning, you're just going to find more and more opportunity. And I think both Kevin and Astra had identified where the reach and the service offerings have been able to bleed over and move laterally through the various needs that the business office might have. So whether it's selfish a bit because of my interest in the benevolence of this market, or whether it's just because we all want to extend our businesses, we want to generate revenue, we want to employ good people, and we want to make customers happy, which those are all good things in a work day, right? If we can do that every day, it'd be a great week. I think that the EBO strategy provides a lot of opportunity, not only for those that are deeply immersed in it to continue to kind of move laterally through the wallet, but also those that have maybe done some sorts of programs that are supporting providers, and the reach could definitely extend.
Thanks, Steve. Astra, do you have any sort of parting thought?
I think we, the main comment here has been the partnership, aligning yourself properly to be transparent, so you're functioning as your client sometimes in an EBO environment, picking up the policies and the procedures and following them to the line so that we are a seamless process to our client. It becomes really how configurable you become to a client-specific requirement and needs. So I think it's very important that you are a little bit flexible, so to speak, in terms of being open for learning new challenges and aligning yourself up properly.
I think that's great advice. Kevin,
Yeah, I would kind of go along the same load. Leave, parting thoughts would be, portray yourself as a partner, not a vendor, and obtain as much data and analytics that you can to make extremely good business decisions and informed decisions when working the accounts. So at the end of the day, you're providing a huge return on investment to your clients, and you're providing the patient experience that they expect.
And I think I would just echo those things: the partnership, the approach, the good use of technology and data, which is really widely available out there to help you run a better business. And I think the opportunity is just beginning. I think if you're not in this market today, don't feel like you've missed the boat. I think there's plenty of time to get in and find your niche. And it's a pretty exciting place to explore. I think it requires expertise and just applying yourself and understanding it in all those ways, and then I think you'd be very successful. So, Mike, I think that's the end, and
all right.
You need to close down, or
I will talk us out, if you don't mind. So once again, I want to thank all of you in the audience for spending an afternoon with us. We very much appreciate your participation. I also want to thank today's panelists, Steve Scabetta and Jason Harrington of Ontario Systems, Astrid Blackman of USCB America, and Kevin Vernon Harris of Experian Health. If you have any questions about the content in today's presentation, you have a variety of ways to reach out to a lot of different people. So you can send those to editor@insidearm.com or any of the 4 email addresses that you see on the screen right there in front of you. And then we will make sure the questions that come through that way, we'll ferry those to the appropriate responder. If you have any questions that weren't answered today and you really wanted to get an answer to them, make sure that when you're doing that survey that I mentioned at the end of this call, if you could go ahead and fill it out in that section, that would be very helpful to everyone. And that about does it. So thank you again. We hope to see you next time, and we hope you all enjoy the rest of your day. Goodbye.